The Nasdaq debut of VinFast, a Vietnamese electric vehicle manufacturer, has sent shockwaves throughout the market, giving it a valuation that exceeded those of Ford and GM. VinFast had agreed to merge with its SPAC partner, Black Spade Acquisition, at $10 per share, valuing the company at $23 billion. But its stock more than doubled and was trading at $22 as the market opened on August 15th. By the end of its first trading day, VinFast stock closed at just over $37, and its valuation skyrocketed to a staggering $85 billion. But how can a company with just a few years in the EV market and with only about 19,000 electric vehicles sold be worth more than the industry giants like GM and Ford? Is this rapid rise and aggressive valuation a sign of dangerous market excesses and that a market bubble could now burst at any time? Or is VinFast a unique case in the world of EVs? In just a few short years, VinFast has gone from a complete unknown to one of the world's most talked about electric vehicle makers. The company had its Wall Street debut recently with a bang, even though its production numbers and profitability don't quite match its market valuation. The stock soared by more than 250% on its first trading day, and its founder's net worth exploded from $5 billion to $44 billion, making Pham Nhat Vuong Asia's fourth richest person. But the excitement was short-lived, as the stock crashed by 46% over the next two trading sessions and closed at $20 on August 17th. Are we starting to witness cracks forming in the market? Other new entrants in the EV space, such as Fisker, Rivian, and Lucid, have also seen their share prices collapse dramatically after going public. The pattern raises concerns about whether the market is overly exuberant about EV startups without a proven track record of profitability, highlighting possible severe market excesses. The global EV market is certainly booming, and there's a lot of hype around it. The rise of Tesla, for example, has changed the game for the auto industry. Its market valuation has reached astronomical heights, and now, other companies like VinFast are trying to replicate Tesla's success. However, the road to profitability in the auto industry is steep, with high capital costs, fierce competition, and thin margins. VinFast went public by merging with a SPAC rather than through a traditional IPO, a path that has become increasingly popular as it can be faster and often cheaper. When the stock started trading and its market cap surged to $85 billion, this skyrocketing valuation raised eyebrows. After all, VinFast posted a $2.1 billion loss in 2022 and reported that revenues plunged by 49% during Q1 of 2023, while its quarterly loss widened to $598 million. How can the market be placing it ahead of American automotive giants like Ford and GM, companies with a long history and millions of cars sold annually? Are investors so enamored with the potential of the EV market that they are overlooking the fundamentals? Market watchers and analysts have pointed to several factors driving these wild price swings. One is the limited availability of shares. VinFast's founder, Pham Nhat Vuong, still controls 99% of the company, leaving only a tiny float for trading. This restricted supply of shares can amplify price swings as the market has less liquidity. Yet, the tiny float available for trading only explains these gigantic ups and downs partially. A more concerning aspect of VinFast's debut is the company's fundamentals. It's a young automaker that delivered just 11,300 vehicles in the first half of 2023, a minuscule figure compared to giants like Ford and GM. Its ambitious goals include selling 50,000 EVs annually and opening showrooms in the US. But achieving such targets will require significant capital investment, leading the company's CFO admitting the need to raise further capital in the next 18 months. And this is where the red flags start to wave. Typically, companies with established track records and clear paths to profitability garner high valuations. In contrast, VinFast is still burning through cash with no clear indication of when it will turn a profit. This prompts the question, why would investors pump money into a company over which they have no control and that has yet to prove its business model? VinFast's case may be a classic example of what legendary investor Warren Buffett called the greater fool theory, where people buy an overpriced asset hoping to sell it to a greater fool at an even higher price. We've seen this before in market bubbles, where the valuation of assets disconnects from their underlying fundamentals. One might argue that the EV market is different, and the growth potential justifies the high valuations. But it's crucial to remember that the EV space is becoming increasingly crowded. Tesla, the undisputed market leader, has set a high bar and it's no longer the only game in town. The entrance of legacy automakers and new startups means that the competition is getting fierce. Tesla is slashing prices aggressively, margins are getting thinner, and the battle for market share is intensifying. VinFast's strategy to gain a foothold in the EV market involves partnering with overseas dealers, contrasting with Tesla's direct-to-consumer approach. While leveraging established sales networks in various countries could help in distribution, it also means sharing profits with intermediaries, which ultimately means smaller margins. And then, there's the challenge of convincing consumers to choose VinFast over other well-known brands, a feat that is clearly easier said than done. The EV maker also plans to invest $2 billion in an EV factory in North Carolina. While this indicates a serious commitment to the US market, it also represents a significant capital expenditure that could strain the company's finances. It's a high-risk, high-reward gamble, as breaking into the US market, where consumers have plenty of options and high expectations, might be a rough road for the company. Furthermore, VinFast has experienced internal struggles, including retaining senior executives and offering share-based compensation. This casts doubts about the company's ability to attract and retain top talent, which is paramount for executing its ambitious growth plans. In conclusion, there's a lot to be skeptical about regarding VinFast's astonishing market debut. While the EV market holds immense promise, it's also a highly competitive and capital-intensive industry. VinFast's lofty valuation, when compared to its fundamentals and the challenges ahead, could be indicative of dangerous market excesses. Investors must separate hype from reality and exercise caution when investing in companies with unproven track records. Market bubbles can burst, and when they do, the fallout can be severe. Only time will tell whether VinFast will live up to its sky-high valuation or serve as a cautionary tale of market excesses. So what are your thoughts on VinFast's staggering valuation? Is it the next big thing in the EV world? Or do you think it's another case of a market frenzy disconnected from fundamentals? Let us know in the comments below. If you found this video insightful, don't forget to give it a thumbs up, share it with your fellow investors, and subscribe to our channel for more in-depth analysis of market trends, new technologies, and exciting investment opportunities. Thank you for joining us today, and as always, stay smart and stay informed.